Hey, what's up, everybody? It's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage. Today, I want to break down something that you're hearing a lot about in today's market, and that's mortgage buydowns. What are they? What's the difference between a permanent and a temporary buydown? And most importantly, why sellers and builders are willing to pay for these instead of just dropping the price of the home. Now, let me go ahead and start with the short version for my friends who just want to know what time it is. A buydown is when money's paid up front to lower a buyer's monthly mortgage payment. Now, there's two types. There's the permanent buy down that lowers the interest rate for the life of the loan, and then the temporary buy down that lowers the interest rate for a short period of time. It's usually 1 or 2 years. Now, permanent buy downs, they cost more up front because they're reducing the payment forever. Temporary buy downs, they cost less because they're only reducing the payment early on. Now, sellers and builders, they often prefer buy downs because a few $1,000s in a buy down can actually create the same payment relief as tens of thousands of dollars in a price drop without hurting home values. Now, let's slow this down a little bit and let's build the clock. At its core, a buy down is pretty simple. Someone, whether the seller, the builder, or maybe you pay money up front in exchange for a lower monthly payment. Now, the difference between permanent and temporary buy downs is how long that lower payment lasts. On a permanent buy down, that lowers your interest rate for, as I said, the entire life of the loan. Usually, you're paying discount points at the time of your closing to do this. Now, let me use an easy example. On a $250,000 loan with a 30-year fixed rate mortgage around 6.25%, paying one discount point would cost about $2,500 up front, and it might lower the rate by around 0.25%. Now, what that does is lower the monthly payment every single month. It reduces the total interest that you pay over the life of the loan, and typically it does take several years to break even. What I mean by this is if it costs you $2,500 for the buy down, you have to look at how much money you save monthly and then divide the cost by the monthly savings. It's usually about 3 to 5 years. Now, permanent buy downs, they do tend to make the most sense if you plan to keep the loan long term and you don't expect to refinance anytime soon. Now, if rates were at their absolute lows and you're buying a home that's been in the family forever and you're just never leaving, this would be a great time for a permanent buy down. Now, a temporary buy down works differently. It lowers the payment for a short, defined period, most commonly 1 or 2 years. Now, the most popular example right now is the 2-1 buy down, where basically you get a 2% reduction for year one, a 1% reduction year two, and then it goes to the full interest rate that you had initially. It is a fixed rate. Now, using the same $250,000 loan in today's national average rate of about 6.22, the full principal and interest payment is roughly $1,540 per month. With a 2-1 buy down, the payment in year one drops to about $1,230 per month. In year two, it steps up to about $1,370 per month. In year three, the payment returns to the full $1,500. There's no adjustable rate here, there's no balloon payment here, just a temporary reduction that expires. Now, that lower payment isn't free, the savings are actually prepaid up front. In this example, the year one savings are about $3,720. The year two savings are about $2,040. Now, that means that the total cost of the 2-1 buy down is roughly $5,700. Now, that money is paid at your closing and it's placed into a temporary escrow account. And each month, that account is going to cover the difference between the reduced payment that you have and the real payment. Now, most often, that cost is paid by the seller or the builder. Now, here's the part most people just don't understand, and this is the why. Why in the world would a seller or builder pay about $5,700 for a buy down instead of just lowering the price of the home? Well, it's because of leverage. To create the same $300 per month payment reduction without a buy down at a 6.22% interest rate, that seller would need to reduce the price of that home by roughly $35,000 to $40,000. Let that sink in for a second. 5,700 or 40,000. Now, on one hand, a seller can actually spend about $5,700 on a 2-1 buy down and give the buyer meaningful early payment relief. On the other hand, they'd have to discount the home by more than $35,000 or $40,000 to get the same effect in a price reduction. That is why sellers and builders prefer buy downs. A small upfront cost creates a big payment impact without resetting values lower. Now, builders want to protect the neighborhood pricing. Sellers, well, they want to protect comparable sales. Lowering prices too far, it hurts future appraisals and future listings. Buy downs help homes move without dragging down values. Now, here's the important coaching moment. A buy down helps the payment, not the price. That's great for affordability early on, but it means you still need to be able to afford the full payment when the buy down ends if you're doing a temporary buy down. Temporary solutions should never ever be used to fix permanent affordability problems. So when you hear somebody say they're offering a buy down, the right follow up question isn't, hey, how low is the payment? It's how long does that last and what happens to my payment after it expires? So next week, I'm going to break down temporary buy downs, especially the 2-1 buy down, and in more detail. And I'm going to show you exactly when they make sense, when they don't make sense, and how to avoid the mistake that I see buyers make every single week. Hey, if you're buying, building, or selling, and you want some help deciding which strategy fits your situation, let's walk through the numbers together. No pressure, no sales pitch, just clarity. I'm Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage. Thanks for watching, and I'll see you next week.